Let me run through the next wave of AI IPOs. SpaceX, already public as of June 2026. $1.75 trillion at IPO. Biggest IPO in history. It joined the Nasdaq 100 on July 7th, just 15 trading days after going public. Anthropic, the company behind Claude. Their valuation has exploded from $61 billion to roughly $1 trillion in about 18 months. S1 filing expected any day now. OpenAI, the ChatGPT company, valued at $85.2 billion. IPO expected later this year. Add those three up, $3 trillion in new market cap that's going to be knocking on the door of your index funds. That's about 5.2% of the S&P 500's total weight, just from 3 companies. And Business Insider estimated that if SpaceX, OpenAI, and Anthropic all joined the S&P 500, the top 10 stocks would jump from about 40% of the index to roughly 50%. Half the index, in 10 names. So here's the mechanics. This is where the sausage gets made. When a company gets added to the S&P 500, every passive fund that tracks the index, that's about $16 trillion in assets, is required to buy that stock at whatever price the market gives them. And guess who knows this is coming? Hedge funds, frontrunners. They accumulate the stock before the announcement, knowing that trillions in passive money will pile in after. They enter at $100, the index funds are forced to purchase at $115, and the hedge funds pocket a clean profit. Kiplinger called it what it is. Basically a wealth transfer from long-term index investors to fast money pros. And it gets better, or worse, depending on your perspective. In May 2026, Nasdaq introduced a 15-day fast entry rule. Any IPO with a market cap over $100 billion can join the Nasdaq 100 after just 15 trading days. No seasoning period, no time for the market to discover a fair price. SpaceX was the first to benefit from this, so the passive funds are buying faster, at prices that have had less time to settle. Great! This isn't just theory, it's been studied extensively. A professor named Petajisto published a landmark paper in 2011 showing that S&P 500 additions experienced an average 8.8% price bump from announcement to inclusion. The hidden cost to index fund holders, 21 to 28 basis points per year. With $16 trillion in passive S&P 500 money, that's a wealth transfer of $10 to $13 billion annually from you to hedge fund traders. Now, more recent research by Greenwood and Shang showed this index premium had been shrinking from 7.4% in the 1990s to less than 1% in the 2010s. But here's the catch. Those declining numbers were for companies migrating from smaller S&P indices where there was offsetting selling. The new mega IPOs, SpaceX, Anthropic, OpenAI, they're coming from outside the index ecosystem entirely. There is no offsetting seller. These researchers and several others warned that the index inclusion premium could reemerge in a big way for exactly this kind of mega IPO. Alright, so what do you actually do about it? Here are 4 ways to protect yourself from the concentration trap and the IPO dilution tax. Instead of giving Apple 7% and some small cap stock DOIT 1%, an equal weight fund gives every stock the same allocation, about DOIT 2% each. The Invesco RSP is the big one. It's actually been outperforming VO year to date, 20% versus 11%. A new $1 trillion IPO? It gets the same DOIT 2% weight as a $10 billion company. Problem solved. The downside, higher expense ratio, more turnover from rebalancing, and you're giving up some of that Mag 7 upside when they're running hot. This is where things get really interesting. With direct indexing, you own the individual stocks inside the index, not an ETF that bundles them. And that means you can exclude specific stocks. Don't want Anthropic at a $1 trillion valuation with $47 billion in revenue? Exclude it. Think SpaceX at $175 trillion is insane? Leave it out. Plus, and this is the real kicker, you can do tax loss harvesting at the individual stock level. You can't do that with SPY. Minimums have come way down too. Vanguard, Schwab, Fidelity, and a bunch of fintech platforms now offer direct indexing starting around $2,000 to $10,000. For full customization, you're looking at $100K plus. Not financial advice. This is educational content only. Always do your own research before making any investment decisions. Past performance is not indicative of future results. Instead of weighting by market cap, which is basically a most popular stock win system, these funds weight by revenue, earnings, or dividends. Overvalued IPOs with high market caps but weak fundamentals automatically get less weight. The Wisdom Tree earnings, weighted funds, the RAFI Fundamental Index, and quality factor ETFs like Qual and SPHQ all do this. It's not a perfect solution, but it's a structural filter that most index funds lack completely. This one's subtle but real. Vanguard found that their total stock market ETF, VTI, got 67 basis points more return out of Tesla's inclusion than VOO did because VTI started accumulating Tesla earlier at lower valuations. For mega IPOs, having the broader total market fund means the forced buying hits at a smaller weight earlier. It's not a cure, but it softens the blow. Look, I'm not saying abandon passive investing. Index funds are still one of the best wealth-building tools in history, but pretending they're perfectly diversified in 2026 is delusional. You've got 7 stocks controlling a third of the index, a wave of AI IPOs about to pile even more money into the same sector, and institutional structures that literally force your fund manager to buy overhyped stocks at inflated prices. The passive investing revolution was supposed to democratize Wall Street, and it has, but the fine print says it also made you the exit liquidity for every hedge fund front running an index inclusion. You don't have to accept that. Equal weight, direct index, filter by fundamentals, or at minimum, understand what you actually own when you buy the market. Because right now, the market is 7 companies, a prayer, and 493 passengers. Not financial advice. This is educational content. Always do your own research. If you found this helpful, hit like and subscribe. Links in the description. You think your S&P 500 index fund is diversified. It's not. 7 stocks, just 7, now make up almost a third of the entire index. And the next wave of AI mega IPOs is about to make that concentration problem even worse, while quietly diluting your returns in the process. This is the hidden tax nobody talks about, and if you own an index fund, which, let's be honest, most of you do, you need to understand what's coming. Let's get into it. The Magnificent Seven. Apple, Nvidia, Microsoft, Amazon, Google, Meta, and Tesla now make up roughly 32.5% of the S&P 500. That's 7 companies out of 500 controlling a third of your index. At the peak of the dot-com bubble in 2000, the top 5 stocks were about 18 to 20% of the index. We're now at 32.5%, completely uncharted territory. Apple and Nvidia alone are each flirting with $5 trillion. Combined Mag 7 market cap, about $21.9 trillion. Deutsche Bank pointed out that the Mag 7 is worth more than the stock markets of every country on earth except China, Japan, and the good old USA. Now here's where it gets interesting, and where most people get tricked. In 2023, the S&P 500 returned about 24%. Sounds great, right? But the Mag 7 collectively returned 107%. They accounted for roughly 2/3 of the index's entire gain. The other 493 stocks, they averaged somewhere around 7 or 8%. So when you look at your S&P 500 fund and see a nice return, what you're really seeing is the Mag 7 dragging the index uphill while the rest of the market mostly watches. That's not diversification. That's a 7-stock portfolio with 493 hangers-on. Remember August 5th, 2024? The Mag 7 lost $1 trillion in a single day. $1 trillion. On recession fears and AI spending concerns. And that was just a preview. Every one of these stocks is in the same sector. Tech. If the AI narrative cracks, if antitrust action lands, if one of them reports a disastrous quarter, you don't get a nice gentle pullback. You get a cascade. And because passive index funds mechanically hold the same weights regardless of price, they ride it all the way down. They can't sell. They won't sell. That's the feature, until suddenly it's a fatal flaw. Okay, so you've got this concentration problem. Now let me show you how it's about to get worse, and how it's going to cost you money even if Mag 7 keeps ripping.